A bold new era of anti-fraud measures is upon us, and it's set to revolutionize the way benefits are managed. With a staggering £9.7 billion in losses and a projected 5% annual rise, the government is taking action, but not everyone is on board. The state pension, a cornerstone of financial security for many, remains off-limits, sparking controversy and raising questions about fairness. The battle against fraud, a necessary evil? The Department for Work and Pensions, DWP, is gearing up for a major overhaul, aiming to tackle benefit fraud and error with enhanced legal powers. Starting in April 2026, this initiative promises tighter controls and quicker responses to potential issues. But here's where it gets controversial. While some benefits will be under the microscope, the state pension is exempt from the most intrusive checks. What's changed and when? The Public Authorities Fraud, Error and Recovery Bill grants the DWP new authority to address fraud and errors. The first phase begins in 2026, with a full rollout expected by 2031. Officials argue that outdated rules need an update, especially given the rise in fraud since the pandemic. Under this plan, the DWP can recover debts faster, even directly from wages and bank accounts. They justify this by citing a sustained increase in fraud and a projected 5% annual growth without intervention. The state pension, a safe haven? The DWP assures that they won't be peering into your shopping habits or transaction history. Banks will only share limited data when specific risk indicators are triggered. But the state pension is exempt from these checks, a decision confirmed by the government. Pensioners receiving only their state pension won't face account flagging under this measure. However, pension credit, which is means tested, is not exempt. This distinction is crucial for mixed households, where one partner may receive the state pension while the other relies on means tested support. How will the checks work? The DWP will issue banks with eligibility verification notices, listing specific criteria to check against benefit receiving accounts. Banks will run these checks internally and provide minimal information if an indicator suggests a potential issue. If an alert is triggered, the DWP can investigate, request evidence, and adjust benefit awards. A human caseworker, not an algorithm, will make the final call. The bill ensures independent oversight and regular updates to Parliament. What could trigger an alert? The full list of indicators is not public, but they are expected to align with eligibility rules for means-tested support. For example, patterns suggesting high savings or capital, inconsistent earnings, changes in living arrangements, long absences abroad, or multiple active accounts receiving the same benefit. These signals don't automatically indicate wrongdoing. They prompt a check to validate details, correct errors, or investigate potential fraud. Who could be affected? The data matching regime focuses on means-tested benefits. If your financial situation changes and you don't update your claim, your account could be flagged for review. This includes benefits like universal credit, housing benefit, income support, job seekers allowance, employment and support allowance, council tax support, tax credits, and pension credit. The numbers behind the clampdown. Losses remain high compared to pre-pandemic levels. Officials argue that faster checks will prevent overpayments and reduce the debt burden on claimants who make honest mistakes. What you should do now. Report changes promptly. Notify the DWP about shifts in earnings, savings, partner status, or rent as soon as they occur. Keep records. Save payslips, bank statements, and tenancy documents to support your claim if needed. Check capital limits. Universal credit typically stops when capital exceeds £16,000. And pension credit has its own rules. Update online accounts. For universal credit, use your journal to record changes and upload relevant documents. Respond promptly. If the DWP contacts you, answer quickly and keep copies of all correspondence. Challenge mistakes. If you disagree with a decision, request a mandatory reconsideration and provide evidence. Example scenario. A universal credit claimant receives an inheritance, pushing their savings above £16,000. Their bank flags this as a potential change in eligibility. The DWP requests evidence of the capital change. If the inheritance arrived during an assessment period, entitlement may stop from the next period. If the inheritance was declared, providing bank statements and decision letters should resolve the alert. Privacy and safeguards. Officials emphasize that they won't monitor daily spending or track individual purchases. Banks will compare customer data with set indicators, and only minimal details will be shared with the DWP. A human review will precede any changes to payments or debt recovery. The bill includes independent oversight and regular reports to Parliament, balancing fraud prevention with privacy rights. This framework allows scrutiny of the powers used over time. Key takeaways for pensioners and mixed-age households. If you rely solely on the state pension, you're exempt from the bank check regime. However, if you also receive pension credit or your partner claims means-tested benefits, your household may still be within scope. Stay organized, report changes promptly, and check if any top-ups you receive are means-tested. This initiative aims to strike a balance between fraud prevention and privacy, but it's a delicate dance. What are your thoughts? Do you think these measures go too far or not far enough? The floor is open for discussion.